Rick, the numbers.
Yes, and boy, these really go in two different directions, Andrew. We see initial jobless claims moving from a post-COVID low of 194,000. That was revised from 199, zooming up 28,000 to 222,000. On the other hand, if you look at continuing claims a week in the rearview mirror, it moved to a post-COVID low with some force. Last week, revised to 2,063,000. Now we jump under the handle of 2 million, 1,956,000, a huge move. Now, granted, the big notion we read about constantly is, well, these are seasonally adjusted. So, and that was the reason why last week we were under 200,000 is because of the seasonal adjustments when you compare non-seasonally adjusted. But I will say this, that all the years we've all been doing these numbers, there's always been seasonal questions. But now, of course, it rises to a higher level because of all the uncertainty regarding the economy, jobs, the Fed, and how all that figures in with, of course, various variants and Greek letters in the alphabet. As far as interest rates, Andrew, there's something huge going on. The yield curves are flattening today just dramatically. I'll give you an idea how wild this is. If you look at the high mark, post-COVID for a 2-year note, it was right around Thanksgiving. It closed at 0.64. Right now, it's at 0.60, so a difference of 4 basis points. Now, let's look at what's going on, for example, in a 10-year note yield. Its high water mark was 1.7. It's at 142. That's a difference of 28 basis points. It's 28 basis points away from its recent high yield. 2-year note yields are only 4 basis points away. 30-year bonds are 42 basis points away, and 10-year boons are 30 basis points away from the recent highs. So the long-dated sovereigns across the globe are snoozing a bit, as they always do when the market senses an aggressive tightening cycle coming up. It's something that everyone needs to pay attention to. Back to you.
Rick, thank you for that. I want to get straight over to Steve Liesman, who joins us with more. What's your take?
There was a really interesting story in the Journal this morning. Joe, are you there, Joe? Because it was about one of our favorite topics, which was not the Grateful Dead or the appropriate version of me and Bobby McGee, but one of our favorite topics, Joe, the terminal rate.
Yes.
And I think that's what Rick's talking about. I don't know if Rick is still around, but, after Bobby McGee, you and I have talked about the terminal rate. They get there quick, but what is the number? And that's what's interesting is the article this morning argues that that 10-year number at 148, 150 suggests that the bond market thinks that terminal rate, and let me just explain what the terminal rate is and why it's important. The terminal rate is where the market thinks the Fed is going to end up in the tightening cycle. And that's important because essentially the market tries to price that in as soon as possible. As soon as the Fed shifts, the market tries to get to the terminal rate as quickly as it can. And this idea that the terminal rate is at 150 suggests that the market thinks the terminal rate is going to be very low. The 2-year seems priced, not badly relative to what we think is going to happen next year or the next couple of years. Maybe it's a little low, but not crazy off. But maybe 150 is the right number, which means the market thinks the terminal rate for the Fed is lower than it was before the pandemic.